make this informal question and answer type of session. I mean, how many of you are in various stages of company formation and thinking about fundraising and thinking about whether to pursue venture capital as one of those avenues, versus companies that have already taken venture capital or other sort of participants in the market?
Well, CipherLock, I'm sorry.
Go ahead.
CipherLock, we're about 2 years old. A year and a half will be 2 years old in September. We're angel back now. And the angels are solid angels, but we're considering VC from a smart money perspective, where we've got some really great things happening with the company. The angels don't have software industry expertise, never mind authentication or security background, which we're looking for. So some of the VCs that we're talking to, seem to have a Rolodex, maybe some roll-up companies, existing portfolio companies that could help accelerate, or what we deem as being help us to accelerate our go-to-market strategy. So that's why we're right now at Crossroads thinking about working with some traditional VCs.
So thinking about investors in the context of what else they bring to the table, what type of connections and knowledge and things they can do strategically for the company.
Sure.
Okay. What others?
I run a company actually that helps companies with their investor presentation, their pitch. So I have companies that I have clients, I should say, that have already raised venture money. I have clients that are publicly traded. And so I'm always there helping them, making sure that what they're saying is convincing and is really telling investors what they want to hear. So I'm always interested in hearing from the perspective of what people, professional investors such as yourself, what you're looking for now, even in this challenging environment, what kind of companies people are considering, really what it takes. So
sure.
That's one way.
Sure.
All right. Well, I'm with a company that's a little over 3 years old, and we're profitable, but we're small, and we're thinking potentially about going out for money to grow the organization. So we're going to drop that in.
Sure. Sure.
What do you guys do? We're a application security company. So we do. We've got a software as a service product that basically does application pen testing. So.
Can you tell us a little bit about Atlas? I didn't have a chance to dig into how big you are, what your portfolio is. Is security a sweet spot?
We're one of the older venture firms in the industry. We started out in Europe in 1978. Actually, we're a spin-off from ING Bank back at that point in time. We've since gone on to raise 8 funds, and so each fund is a batch of money that's invested and then harvested about 10 years later. And so we've raised 8 funds. We have over $2.5 billion under management now, cumulatively, that we've invested over that time. We have a pretty broad industry focus. We have a life sciences team that principally does pharmaceuticals and some devices. And then on the technology side, of which I'm a part, we do everything from digital media to materials and clean technology and alternative energy through to core infrastructure software. We do have a partner who's really focused on security, and so that is a bit of a sweet spot for us.
Who's that?
Jeff Fagnan. And but there's I also do a lot with data storage and software that runs tangential to the storage, so database. So it's more infrastructure software. We all have on our team. We all have very deep technical backgrounds. Many of us have been entrepreneurs in the past, or technical founders of companies. And so it's those are the types of investments that we naturally gravitate towards.
Early stage?
Early stage. Probably 60% of the first investments we do in a company will be during the A round. Sometimes we'll invest in a seed round as sort of a stepping stone to get the company to a point where it's ready for an A, maybe to answer some questions that about the business model or things that we haven't quite figured out yet. Sometimes we'll come in a little bit later. I think with the energy deals, we tend to be more open to investing in a B or a C round, just because those companies have such long gestation periods, and they have a whole scale-up phase that they need to go through because they're typically tangible products of one form or another. And so, there we might move our focus a little bit later, just thinking about exit windows and time to market and considerations like that as an investment.
How many people in Atlas? How many? I'm trying to get the
Right.
personnel at Atlas.
On the
ratio.
in Boston on the tech side, there are 7 of us.
Okay.
So
And what net portfolio companies currently that you guys have?
I don't know the exact number right now, but I'd say it's in the 30s.
You guys are in Pittsburgh, right?
Mm-hmm. And that's Jeff Fagnan, who is the investor in those. So kind of the security angle there. So.
You mentioned Boston, but you have other facilities.
Yeah, we have an equally sized office in London,
Okay.
and so we have a big footprint in Europe as well, and we do pretty much all of our North American investing out of Boston. I find myself on the West Coast fairly frequently.
You going to RSA?
I'm not going to make it. I just have a schedule conflict. But we have one person in China actually sourcing deals, and she's been out there for about 3 years. And we've seen some things come out of that. Although principally our focus is sourcing deals in Europe as well as Israel, and then North America, in particular the Northeast. So that's kind of the profile on us. I would say one of the things about raising venture money is that when you contemplate, sometimes you do it for different reasons. Like you see an opportunity to grow the business, you want to do that. You want to bring in domain expertise, or you want to bring in strategic partners or connections and the like. One thing to think about is the company a fit for venture capital, and is venture capital something that you want to introduce into your capital structure insofar as the return expectations that venture investors bring with their money. You might have a business that is cash flow positive and quite rewarding for the current angel investors and you as a founder in the company. But when you go and bring venture capital into it, you are basically signing the company up for a big swing, and trying to be a $100 million, $200 million outcome in terms of an exit in the next 7 or 8 years, versus a company that might go on and be $20 or $30 million in value and just keep on going. The venture investors are, just because of the nature of their fund and the way it's structured and their model, are always looking for investments that have that potential. And when they see an investment that has that potential, they're going to try and make it realize that potential through the amount of capital that goes in, the size of the company, the number of employees, the pace at which things are brought to market, the aggressiveness with which a sales force is built and deployed. And so it's something to consider as an entrepreneur, as to whether that's right for your company and it's something you want to do, and whether the industry that you're in is appropriate for that. And so it's something we spend a lot of time thinking about that as investors, and the entrepreneurs might as well too, because when we go in and do one of these things, we do it sort of in terms of there's a social contract and there's a partnership in terms of embarking on this together. And if it's not a fit, then there are other sources of capital. There's angel money. There are investments from strategic partners or from customers that you can go and pursue that for certain types of companies might make more sense. So.
What are you seeing today, given the down economy? Have things changed? Have, the multiples changed, valuation, all that stuff? Has it changed
It has.
dramatically?
Well, there are sort of two components of the change. There has been a lot of change. Multiples are down, the traditional acquirers or software companies are out there and they are actively looking at companies to buy, but it's bargain season for them. What may have been an offer that was 3 times revenue 18 months ago is now going to be 1 times revenue. And they have so much deal flow that they're looking at and so many companies that they're seeing approach them to sell to them that, in a way, these acquiring companies are overwhelmed in terms of getting up to speed on what the company that they're considering does, and actually engaging with it and deciding to work on a deal. And so they're faster to dismiss something if it's not a fit, if it's not priced attractively for them right now than they would have been, say, at the end of 2007. That is a function, though, of this economy and the fact that there are a lot of private companies in venture firms' portfolios that, because of the recession, have seen what they thought was their exit timeline get extended out into the future. These companies are, 20, 30, 50-person firms. Maybe they're not cash flow positive yet, and so there's a big bill to run them every month. And the venture firms, collectively that have these portfolios of companies, don't have the capital reserved. They didn't allocate enough capital to anticipate, such a severe and such a widespread downturn in the economy. And so as a result, a lot of these companies are trying to get acquired right now. When everybody goes to market and it's a down economy, of course, prices are going to be, M&A multiples are going to be affected, and that's exactly what's happening. The other component, though, of what's changing is, I think, less transitory. It's more of a sort of sea change in the nature of software innovation. Versus, say, the 1990s, we've gotten a lot of productivity gains out of software as an economy over the last 15 years. And so companies today that are bringing innovations into the marketplace, the innovations tend to be somewhat more incremental than they were in the past. They also tend to require less capital, which is a positive for the entrepreneurs, because the development tools and the services available to you and the technology and the ability for a startup company to gain worldwide reach with its product or its message or its marketing, in particular through the internet and through the ways that we can communicate now, and deploy software as a subscription service and things like that, make it incredibly cost efficient for companies to get out there. But of course, a lot of companies are out there. There also has been a change in the field of acquirers over the last 15 years. So, a lot of the startups that were funded in the early 90s and were successful and went public back then have grown into massive software companies that have huge sales forces. They have brands. Corporations tend to gravitate much more towards buying from big enterprise software vendors than startups, and that hasn't always been the story, but it is to a much greater degree now. And as a result, the Microsofts and IBMs and software AGs of the world are out there looking at startups as acquisitions more for their technology team and their product than their brand and their sales force and their revenues that they bring in, because they already have all of that, and they can just take this and slot it into their product line. And so they're tending to look for companies earlier in their evolution, and they're tending to pay less for them, because if they paid up for a company that had a lot of revenues and had sort of a brand of its own, they would probably end up during the merger integration stripping that away anyhow, and taking what they really can utilize as valuable. So that dynamic and sort of the maturation of the software industry, the changing nature of the innovations, the reduced capital requirements, are all sort of driving towards sort of an environment where multiples are down. Companies are being bought earlier, albeit on even less or even non-existent revenues. But the traditional sort of cycle that we knew from 10 years ago of how a software startup evolves, gets into the market, grows, maybe even goes public or gets acquired for 400, $500 million, has changed and changed in a way that I think is sort of more of a permanent change in terms of the evolution of the market than something that's just going to cycle back. So.
Yeah, I agree with that. I mean, there's other dynamics that talk to what you're saying about the fact that the number of buyers is actually shrinking. So while an ISS may have done a ton of acquisitions, ISS is no longer. Secure Computing is now part of McAfee. So the people you go pitch your deal to inherently is a smaller group of folks. So from a supply and demand point of view, the demand is now reduced by X percentage. I don't think that's going to change at all. I think we're seeing fewer vendors grabbing more and more share. And Oracle, I know for a fact, is looking at what you're talking about, smaller companies that are technologically very important from either an IP point of view or just from a client demand point of view. Not necessarily that they do 20, 40, 100 million in revenue. It's more a function of what they can do to slap into their system. Now have their 1,000 sales guys go nuts with this, yet another tool in the kit.
It makes us think about sort of our investment approach and how much capital we want to put into a company, sort of with the idea in mind that we want to get a certain multiple on that investment. And so, if we kind of take the sobering sort of assumption and say, the majority of companies that are successful in their space are going to sell to Oracle or IBM in sort of the $50 to $70 million type of M&A event, then we're going to adjust our investment to say, okay, well, we're going to try to put less money into these companies, grow them in a more capital efficient way, maybe invest earlier as a result to still have reasonable ownership in the company, and try and play that game, and not necessarily try and force things or force our assumptions to say, hey, we have to sell this for $200 million when the market isn't bearing that anymore. So.
So, speaking of playing games, can you talk to us about valuation? How you look at a company, its early stage, and how you determine valuation, and when dealing with the existing management community, entrepreneur, how do you try to justify or present that valuation?
It's difficult to put a value on a big idea that's just in its really early stages. And even if you just wanted to try and do it from sort of the academic standpoint of doing an accurate valuation versus a negotiated valuation, it's very difficult to even get close to what if you could walk 5 years into the future and then look back and say, oh, well, this company should have been valued at that time based on the cash flows that we have now seen happen. It should have been valued at X million dollars. So everybody's kind of pragmatic about that fact, and the way valuations work out, especially in A rounds, is it's driven by the amount of money that you're raising, and it's driven by what are sort of perceived as reasonable levels of ownership for the various stakeholders in the company. And what happens in the later rounds is if the company gets to an exit on that first money, then great. And if the company needs more money into a B round, a C round, and a D round, and a bridge, and all of these things, the ownerships are not necessarily just mathematically changed according to the money going in, but rather, the management's ownership is protected and re-upped because you need management to be, motivated and feel like they're a part of the company. Otherwise, the company is really nothing without that. The investors, the existing investors who stay, maintain their ownership. The existing investors who don't invest in the next round typically get washed out, and so it all tends to play out according to the chronology of the company in a way that keeps everybody motivated and in it. So that early valuation is I guess in a way revised, based on how the company plays out.
So you don't have a new methodology taking into consideration all the factors that you mentioned, how paradigm has shifted to calculate valuation?
The way we look at it is, we look at our target ownership, which is usually in the mid-20s in terms of percent. And we also tend to syndicate the investment with another firm that has similar goals for their ownership. And
Is that
so
20 or with an additional 20?
with an additional 20. Each firm wants to be in the 20s.
Okay.
And so depending upon the amount being raised, we kind of back into what the valuation is based on getting an outcome that gives us that ownership. And then I guess beyond that, it's, well, if that doesn't work out, then maybe you change the round size, to a smaller round that gets the company to a place where there's less risk in the company because you've made some progress, and then you can justify another investment at a different valuation at that point in time instead of raising all the money up front.
So we see a pattern, and it's
Mhm.
funny, when you kind of fell right into it from a standpoint that you see folks that want to say have 40,
Mhm.
big existing shareholders, they have 40, create a 20% option pool, and then this is how it is.
Right.
So it sounds,
Yeah,
in
it's
line.
kind of where it all comes out.
gotcha.
Yeah. If you haven't hired much of the management team yet or the engineers yet, then that employee option pool is going to need to be up around 20%.
Sure.
Whereas if pretty much all the slots are filled, it can be less than 10%.
Right.
So
How do you calculate, I don't know how many of you guys here have IP or patents. How do you base valuation, or how do you look at patents as part of your strategy? Like you mentioned
Mhm.
Oracle, that they're looking for technologies that if they can get something that has IP, that they can factor in, the channel's already there, they have the products, and it just bolsters it. It's a great
the patents drive the decision of whether we want to invest or not.
Yeah.
I think in the first
What about
place.
global patents? Do you care, or is it really just the States?
I think the States and Europe. I think getting a global patent beyond that is, I'm not an expert, but it's fairly straightforward if you have those two jurisdictions. But it's sort of that piece isn't central. The things that we're looking for are, A, do you have freedom to operate? So are you infringing on other prior art or other people's patents that you haven't licensed yet or that you haven't worked out that arrangement? And then B, have you filed sort of the appropriate IP around what you are doing? And then depending upon the industry, people may value that a lot, or they may not really care. They may not value it that
Yeah,
much.
values it.
Well, it depends on the industry. Like in lighting, in solid state lighting, for instance, patents are a pretty big deal. Certainly in pharmaceuticals, patents are a pretty big deal. In other areas, they are they're more of a negotiating card, and when you get into a patent dispute with another firm, you probably tend to have a lot of back and forth and a lot of a lot of lawyers involved. But ultimately, what comes out is, okay, well, we're going to cross-license the patents, or here's a royalty stream of 1.5% or something like that out of it, and that's kind of how things tend to settle out in certain industries. So it depends.
I think it's, in my opinion, it's pretty important. So I'll cite this side you guys know that company was eventually acquired by Symantec, but Zomaz went after them on a patent infringement and hamstrung these guys to the point where they were really caged in. And it absolutely affected their business plan, and it absolutely affected their outcome. And as a VC, and look at this before, if you're investing, I don't want to have that risk. You want that risk mitigated as much as you possibly can.
Mhm.
As part of due diligence, you may actually think you don't have an infringement, but in fact, it could be a dispute nonetheless. Without at least the patent in place, or try to claim such right or such protection of your IP. As a VC, I personally would be looking at it going, all right, this now has a whole other element of risk, so if I'm going to play it all, that's going to affect my valuation, I would imagine, to a certain extent.
Mhm.
But a lot of these I know would not play unless there's a defensible intellectual property.
What do you think Jeff would say about patents and security?
I don't know.
Would he be here later?
I don't think so, but I saw him earlier this afternoon back at the office, but I don't know what the rest of his schedule is.
I wouldn't speak for him, but he, as part of the director,
Yeah.
So it was a big part of the value was that.
Yeah.
And no part back to the M&A while on the topic of patents, I'm seeing now more of the smaller private companies that I know are getting calls from law offices in Palo Alto. So, we're just wondering if you're looking to sell or license your patents. And you know that's a front for somebody else. You're saying, if I can buy it something cheap.
Mhm.
Right.
I had one thought about raising money. You mentioned so a lot of the acquisition activities, these sort of large established companies at this point.
Mhm.
My personal experience with dealing with the venture arms of some of these companies is that they were pretty much hands off and not active.
The corporate venture
Corporate
arms.
venture
Yeah.
arms. I'm wondering if that's something that now they're going to start trying to become more active and trying to also get involved at a sort of earlier stage with interesting technologies, what they're still going to sort of take.
I think it might make them less active because if they're like, hey, you know, I can buy this company for
Because overall
$35 million.
costs, yeah.
Why would I bother, you know, trying to invest earlier?
Right.
If the companies were, you know, much more valuable at exit, then the corporate VC arms get very active and want to invest earlier and want to, you know, have some piece of that upside, have some visibility into the competitive landscape so that they can, you know, figure out when to make their move and the like. But we've seen, you know, for instance, Microsoft's corporate VC activity drop off because, you know, they're like, we can just buy the thing for cheap anyway.
We wait a year. it'll be
Yeah,
cheap.
yeah.
Right,
Yeah.
It's all cash.
Interesting.
Yeah.
Let me play a scenario out for you. So, down economy, you know, capital budgets aren't there, so you're getting negotiated on everything, right?
Right.
You're getting a lot of users of your software, but you're getting killed on price. For example, we're supposed to sell at $20 per user per year on a kind of renewable license.
Mhm.
You'll get negotiated and say, hey, I got this much, I'll buy it, but I'm going to give you, you know, $7 per user per year. How does the VC who comes in and says, geez, you know, your revenues could have been this, but it's a down economy, you're getting killed on negotiation, there's no capital budget, but you got a lot of users of your software.
Mhm.
If that, just coming back to your evaluation.
I
how do you
would,
look at that?
I would look at the pricing pressure and ask you or ask myself how much of the pricing pressure is due to the economy and how much of it is due to you know, competition encroaching on you, more alternatives to your product that might be a different approach. It may not be a direct competitor, but it's, you know, you can get it done another way, or maybe it speaks to the overall value proposition in terms of how essential it is. I mean, sort of in the optimal case, you would look for products where the product enables the customer to do something they couldn't do before. It's not something that just saves them money and allows them to do what they were doing more cheaply, but it gives them fundamentally a new capability or a new way for them to go and make money. That's the type of product where you get this, you know, this sort of avalanche of adoption in that given customer population because they all realize we have to have this now, or we can't compete with our competitors if we don't have it because they just went and got it. And so, you know, like the advent of the relational database was sort of one of those things because, you know, the ability to manage and query your data, you know, that was pretty profound versus the alternative. It's one of those, you know, capability enhancing type of products, and there have been a lot of those types of products since that. And so when you look at pricing pressure, you know, sort of all of these other questions as to what's driving the pricing pressure and how persistent will it be? Is it something that's just going to, you know, pass in 12 months, or is this part of just an ongoing one-way, you know, slide down the pricing scale?
Can all pricing pressure, especially in software, be a permanent thing? I mean, there could be a situation where, you know, even though right now maybe claim that's the economy,
Mhm.
but, you know, going further and further out, it's, you know, there is competition. There's some other.
Yeah, I think it, you know, pricing can go back up. if you have some other barriers to entry that make your product persistently unique, maybe, I mean, I don't know if eBay, changes their pricing according to, economic times, but eBay is such sort of a central trading hub for so many types of goods. They have the brand, but they also have this network effect because you want to go to eBay and sell your goods because everybody else is there and everybody else thinks the same thing. And so, eBay may not have to lower their prices in a downturn, or maybe they do because, they did the math and they realize, hey, we can still drive more profits through this platform and we can, preserve it for the future if we keep the volume up and we keep customers satisfied, but then the pricing might creep back up when times get better. But of course, the nature of their product has that inherent defensibility. It's more than just a smart piece of software that other people haven't figured out how to write yet.
It would be a heavy part of uniqueness if you want to run their pricing.
Yeah.
I think
Yeah.
a lot of the pricing comes from what's the benefit you can actually show to the customer that's using it, right? If I have a really good product that's going to cut cost for the user, then I can price it much higher than if I can't show that benefit.
The price is so sticky down sometimes too. It's hard to go back and say 1 year later, it's like, well, it's the same basic product, but we want you to give me 20. We want you to give me 20% more.
Right. And sometimes, there are some software products that once a customer decides to adopt them, it's a real pain for them to change and move over to something else. And so that raises sort of the question of pricing strategy as to, say they pay you every year for the use of this system that they've now designed into how they do business. Does it make sense for you to lower prices during a downturn and basically sign up customers at a lower rate for, every year of their contract into the future, or do you keep your prices up where they are and just suffer through lower sales volume during the recession, but still, maintain your pricing?
Do you have any thoughts on how VCs and also the market views freemium models, especially in the downturn? Like a version of freemium free users.
Yeah, I think that they are, generally I think they're good. You need to think through very carefully based on who your customers are, how you structure it, and what you make free and what you make paid. A concrete example is in the database market. MySQL is an open source database. It has pluggable storage engines that you can use underneath it, and these basically support different storage systems, different ways of storing the data. They have different performance profiles for different types of querying. But MySQL is free and open source, and the user community is it's very ingrained in the user community. They don't expect to pay for their database, especially early on in the evolution of their companies. And so if you go into that marketplace with a storage engine that might be free for databases under 100 gigs in size, but then you suddenly have to start paying, you'll find that the customers in that market will reject it, and they won't even use it because they know, I see there's this pricing threshold. It's just a bait and switch. But on the other hand, if you give them a community version of your product that's free forever and they can use it as long as they want and they're never going to have to pay for it, and then you offer them an enterprise version of the same product, but it just maybe has some extra features or it's a little better, that model in that market will work much better than the 100 gig pricing threshold model. And so, so it's a matter of knowing the sort of the individual characteristics of that marketplace. On the other hand, in some of these web-facing, consumer-facing subscription services, freemium is great because it gets people. It's sort of like the free trial of the product. Like there's an invoicing software company for small businesses called FreshBooks, and it's just a simplified version of QuickBooks for businesses to invoice each other, and they have You can just go on there and click which plan you want. You can pay between $0 a month and I think $50 a month, depending upon how many invoices you're sending out. That model works really well for them. They've signed up tons of users, and it's a very profitable little company. Although probably only 1.5% or 2% of the people that use it are paying anything above sort of that first tier of pricing. So I think it's kind of an experiment that you run. You sort of like test how it goes in the market.
I mean, especially amongst the downturn that you guys, would you guys want to see people with more of a freemium model in the software world, or is it?
It depends,
Yeah.
honestly. Yeah, I think that it's absolutely something to consider seriously, and to maybe try out and run some experiments with, and see if you can make it. See if the free one can be attractive enough that people will come and try it, but yet you're still saving something for the paid version.
But these two guys.
Yeah,
It also vastly depends on the product, right?
Yeah.
You are playing in the very, very high, complex market where I can't build a product that you can just download, install, and use for free, where I actually need to come in. There's customization work that needs to be done.
Right.
There's no way I'm going to have a free version, right?
No.
It doesn't make sense.
Right.
If it's something, a web service, I mean, that's prime. It's prime to do that.
Yeah.
I open an account, given I'm restricted to some things, and here it is. Here's it for free. If you like it, if you don't want that banner over every image, then pay me.
Yeah, it especially depends. Is it valuable for the company to have a lot of users or not? And if it is, then the free one has merit, right?
Because you need to support all these people. I mean, at Splunk, we have 300,000 downloads. We need to support all these people, right? How do you do that? Is it profitable for you? Does it make sense? I think there's a lot of factors you have to think through.
You get a lot of community support, like it's community self-support through the IFC channel too. It's like a lot of people.
But you should see how many support tickets you get, where there's actually a person having to read this. So there's a lot of factors you have to look at. I mean, it has help, yes. I mean, there's 300,000 people that looked at the product and gave feedback, right? This thing better works.
Yeah.
And it does work. So there's a lot of benefits, but you have to be very careful. Some products are not meant to be just put in the hands of everyone, which the free version is going to be. And you have to kind of deal with that.
Look at all the big products. I mean, you got Snort, Nessus, I mean, the community got completely mentioned when they decided to. I mean, this is a conflict.
Well, there's different, so we have Snort, it's still completely open, but Nessus is not. So,
Give us some backlash on this.
we get backlash for licensing on our content. People have expectations for getting real-time content updates on Microsoft Tuesday, mention technology. Well, I got a staff of 12 people and a multi-million-dollar lab in order to make things run on Microsoft Tuesday. That costs me money. And if people feel that has value, then I need to charge them money for it, because I only got a couple thousand customers to charge my enterprise rates to monetize open source to but yeah, people do about it, right? Once we explain ourselves, look guys, you want content on Microsoft Tuesday or not? If you don't want it, then you don't have to have it.
I thought companies were ripping you off because they basically wait for you to come up with a signature and then.
Oh yeah, well,
That's the second step, that's good.
right. But the thing is, the pushback was there. But then you say, okay, guys, who here can't afford $30 a year for the individual subscription? That's $250 a month. Hello, cut back on soda.
I think one other comment on is, and this something goes to even, if I dare say, Marty's model, the idea of innovation. You talk about pricing pressure. I covered software for over 10 years. And I can tell you every single company that thinks that they have stickiness or going to command a premium has been wrong for the most part, with rare exception. And the reason why is because they tend to not innovate. They think I can just milk this cow as long as I can. And I'll throw every example like from a Salesforce.com to a Symantec, right? If the lack of innovation does not warrant paying a premium to that vendor, they will either think about mitigating you and putting you in a box to only do a certain amount of product from you, which means your growth within that account is limited, if not confined to zero. or they're going to look for a migration plan away from it.
So there's going to be a continuous feature feed almost if you want to maintain it.
There's more to it than that, so I'll give you a real world example. So SSL is a big problem at SourceFire. So SourceFire is all about network traffic analysis, and having visibility into traffic is very important for us. As SSL becomes more widely deployed, and it does become more widely deployed, so you have craziness like government saying, oh, we're just going to encrypt everything, why not? The problem that you run into is that from a stickiness standpoint, we rely on visibility in order for our technology to work well. If we don't do something about the SSL problem, eventually we're going to lose our stickiness, right? So we have to innovate in that space because that's actually a hard problem to solve. You are innovating in that space. You can see something later on, but that's a real world problem. And the funny thing about it is that we don't see it on the front line. So a lot of times this innovation stuff is going to happen. You're going to have to be the visionary and see it coming because my sales guys don't hear about this. When we're going into a new deal, this is not a discriminator that gets us bought or not bought. This is something that we see down the line when we're into a deal. And then you have the problem of, well, there's no demand. My sales management team says there's no demand for it. Why would we waste our time on it? I know that this is going to be a problem for us because we're going to lose visibility, which means we're going to lose stickiness. So we have to do it, whether or not you're seeing upfront demand.
Do you come down as a position of authority, or do you actually go to sell those people and say, look, trust me, in 1 year's time or 1.5 years' time, you're not going to get sales because you're going to implement this feature?
I'm being a little ahead of empirical data, actually.
There you are.
Yeah, I'm selling internally. I do seminar tours around the world, and so the last one I did a couple of weeks ago, it was on the West Coast. I asked all my sales guys, seeing it? Yeah, we're seeing it. I asked all the people in the room, anybody interested in this? Everybody's interested in it. I go back to my sales management team and I say, look guys, it might not be a super criteria for you, but there's going to come a day when none of our stuff works if you don't have this, and nobody's going to want to pay the maintenance contracts anymore. Is that important to everybody? It's important to you? That's like 20%.
Well, that's the Walmart mantra. No. Either partner or vendor decision between the vendor can. You're either getting commoditized or you're out. So.
And then why they demand out the partners? Is it services? Is it feature?
Well, it depends. I mean, it's something.
Feature pipelines.
Yeah. So I'll throw out a company. I won't mention the name because I'm not sure they want me to mention the name. But one company provides a service for Walmart, a smaller private company. And again, this mandate came down across the board from Walmart, and they said to these guys, "Okay, what are you going to do for us?" And I said, "Well, we have this new module, new reporting module. We haven't, started to charge for yet. It's in beta. Test to see if you like it as we're, taking the, wrap and put a shot in this thing. So if you think about it, so Walmart tried to say, wow, this saves us $250K in the first month alone. So they're like, you know what, your maintenance, we're not going to touch your maintenance. In fact, when this is ready, we'll actually buy it from you. Of course, we want our Walmart discount. But another way from this, the vendor bucket now is off the table. Now they're a partner because they're adding value. They gave them this thing for free. And it's now part of every new Walmart store now, they'll buy this. So they didn't make money on that sale. But they kept their maintenance contract in place, which is great from a defensive point of view. And now going forward, I'm not trying to new Walmart's to be built, but there'll be more at some point. They are now basically, every time new Walmart's up, they got a sales chain. So it's built in. So it actually worked out for them very well from a long-term perspective.
So it's almost like bringing them in for more of the seeing the development cycle a little bit ahead of time. It's like, it can be a...
Well, it also increases Walmart's confidence this is the vendor they want to stay with. But there's value down the line here. I don't need to worry about switching these guys out because they're doing more and I'm getting hard dollar value out of that. I'm saving $250K in the first month. While it may be a small change for this Walmart corporate, they put all their stores, they can start exponentially expanding that $250K, and now it's real money.
But is it across the board, right? All of our customers, I don't regard them as a one sale done, but I go and re-engage with them and make sure that they're happy because for us, the model is we charge based on volume. They buy a small volume license, get them happy with that use case. If they like it, they will expand. And so we are interested in working with them exactly what you're saying. We want to become a partner of these people. And then if they grow out, and by being a partner, we get something back in terms of licenses, but also in terms of getting product feedback of where we need to go.
And getting back to the fundraising, in this environment,
Sure.
I've heard and have had direct experience with the fact that VCs really are focused on their portfolio companies and managing them through the downturn, and not considering a lot of new investing, new investments. Is that true in your case? Are you also sort of seeing that amongst your VC peers? And if you are, considering new investments, has the criteria changed? I mean, you mentioned going to more of a quick hit model, but are there other things that companies should be aware of when they're pitching?
Right. So we just in December closed a new fund. So we are pursuing new investments now. We see early stage investments as an opportunity for the reasons I discussed earlier. And then we're also seeing some later stage companies at very attractive prices. And so we're looking for that as well. All of that is sort of conditioned with the fact of life that we have a lot of work to do in our existing portfolio around their follow-on financings and reserve strategy and the triage that goes on in the portfolio, and a lot of the sort of M&A activity that our portfolio companies are pursuing right now or sort of laying the seeds for. So it's an incredibly busy time for us, and those things take away from the amount of time we have to do the new deals, although we absolutely have the desire to do them right now. Now, I know that there are other firms in the space that are seeing deals and want to do them, and they don't have the capital right now, and it's sort of due to like the timing of these fund life cycles. If you have a fund that's just kind of finishing off here in 2009, that's bad luck. And that means you're going to have to go out and either you're going to have to sit and not do investments for a while, or you're going to have to go out and raise a fund in this environment, which for as long as the market remains down, it's really hard to find LPs that are going to be able to invest in you.
So in terms of technologies, you probably still look at a lot of companies that pitch you a lot, but what are the things you think are hot? Like, what are the things you'd like to see more if you would be ready to invest in? Like, if everything else is right from a technology perspective.
Well, at one level, there are sort of these kind of classic, template attributes of a company in terms of capital efficiency and ability for the company to scale its business without needing to scale its employees and those types of things.
Business operations, but more like technology.
Technology.
What's the market need? Like,
Okay, so my area of focus right now has been around the introduction of flash into enterprise storage and the displacement of hard drives as devices for storage for databases, for data warehouses, for web servers, storage behind virtualization. The random access performance of flash SSDs, especially the ones that are designed for the enterprise, are profoundly faster than hard drives.
Are you in Fusion.io?
We looked at Fusion.io 18 months ago and came within a couple of days of doing an investment in that company. But that is right in the sweet spot.
Yeah.
Really like that company.
Their tech's really hot.
Yeah.
We're using it at CloudMark, and it's
Yeah.
It's nice.
Yeah. And so I think that's it, it's rare to see such profound change happen so quickly in IT these days. But these hard drives have been hanging around for way longer than any of us thought. And now that we're replacing them, we're seeing this incredible performance delta. And what does that do? Well, I think, and this is where I'm looking now, is it creates several pretty big ripple opportunities in the software that runs tangential to this storage. Because, if you think about it, certain big pieces of infrastructure software that we use today make huge assumptions about the fact that they're running on top of hard drives, and they're doing things in the software architecture that accommodate the performance limitations of a hard drive, specifically around random access, because moving that head is like a death knell for an application. And so I'm working on a couple of early opportunities that are essentially storage-related infrastructure software that is rethinking the entire architecture of that software now that we've gotten rid of the drive underneath it. And so certainly not all the big opportunities, but that's the one that I'm focused on right now. I also do a lot in clean tech, but it's kind of a completely different domain. But there are numerous things going on there as well.
are you doing anything in security?
I'm not very deep in security. Jeff covers a lot more of that, but you know, I have a computer science background, so I have an appreciation for it, but I'm just not up to speed on all of the things.
You see about the same thing, where things will be going like technology?
Well, I think, I mean, yeah, I mean, from my, being a software guy more or less, and I'm seeing it, virtualization obviously is becoming the new idea, so I was planning virtualization, because of VMware having the value that it does, and the technological benefits, but also cost benefits of having virtual environments, so be it server side, be it desktop side, what have you. Now there's a lot of management need around that, of course, and management need around that. You've seen nothing really great yet, though. Like Blue got bought out for not particularly a high valuation, but it's a liquidation for them nonetheless. And I still think there's opportunities around systems management, especially as SOA eventually comes in here, and I'll use that term very loosely. Be it software as a service, be it whatever the service is, service orientation, not necessarily the Oracle BEA version of the world, but something around that where you're calling on a service to make data information. And so how do you manage that process from an integrity point of view, from a fulfillment point of view, from a security point of view, of course. So there's some areas around there that I'm looking at as far as what the new innovation might be. And of course, stuff we've talked about on visualization is certainly relevant from, again, this ability to manage the growing vast data you're trying to aggregate and make actions. And I was talking to Marty earlier about from being reactive to proactive. How do you do that? So I think you'll see these kind of step functions in a number of different spaces. It's hard in software, like, take BI, for example. There's now, these guys call them AI. It's just a set of business intelligence trying to do artificial intelligence to take information from a data warehouse and make it more into a proactive, actionable business enhancement. So that's interesting to me intellectually. It makes a lot of sense. Is that a giant leap forward? It probably will be at some point. Maybe it'll be an incremental step function up, going from a classic BI, which, by the way, are already seeing pain points, to a next gen of BI, whatever it may be, and then maybe it's BI, next gen, then maybe AI is the sequence, if you will.
Where the software sifts through the data and figures out the questions to ask rather than just answering the questions that the business unit asks.
Exactly.
Okay.
Or suggest an answer. So the
Right.
simple answer is somebody calls, I call up my credit card company and say, hey, you charged me a late fee and I paid on time. Oh, I'm sorry, Mr. Well, I'm looking it up for you. Here's a the classic BI, let me suggest the product you have, like a HELOC. Well, in this market, I really don't need a HELOC, right? But there are other things that, they might be able to suggest instead of, okay, here's this profile, and the system will basically suggest you should be asking the customer this. You're talking about pitching them that versus somebody doing a quick search. Okay, he has 3 credit cards, he's got a house, he's got a car, trying to do this. Let me think what I got less sell him versus you should be pitching this to him, and theoretically your heuristics will get smarter and better at being proactive and suggesting what might be a monetizable event versus the way they do it right now is you see at the end of the month, you'll do the data mart, see what actually worked, and now you try to go forward, but it's reactive in that sense. You do it on a monthly basis, most people don't, right? It's quarterly to annual on the analysis of what actually helped us sell or make the quarter or the year. So they try to go forward on that, but the market may have changed by now. The customer need dynamics may have changed. So we do it more in a real-time sense, like maybe the better way than proactive, but the real-time actionability of that data store, how you lever that. I think a lot of these guys are starting to target. That's like a power set, execute, some of those guys.
Yeah. Okay. Okay.
Thank you. Thanks for your time.
Yeah, it was really fun. It was a good format. So.
This is probably the first DC meeting or that was this intimate, which was kind of nice. Even smaller groups, just usually someone standing up and you got people isolated. So it's just a nice setting that you pulled it off.
Great. Thank you.
Are you any of you guys planning on going up to the startup showcase or?
Yeah, I was going to hang around for a little while.
Is any of you presenting?
6 o'clock.
Yeah.
Yes,
Yes, we are.
Cool.
Thank you.
All right. Well, thank you.